Hey everyone, it's Robert. Good afternoon. Today I want to do some financial statement analysis to demonstrate how it's done, as well as do it on a very unusual financial statement. No, it's not my financial statement. It is the financial statements of the United States of America. So believe it or not, I took a look and I want to share my screen now and go into the financials of the United States, starting with the balance sheet. Now, when we look at the balance sheet at 9/30/18, which is the country's year end, versus the prior year, we see that total assets totaled 4 trillion. These are in billions, so this is $4 trillion. And our liabilities were 25 trillion. So we had a negative net worth of $21 trillion. That amounts to $152,000 on average, per taxpayer, because there's 141 million taxpayers in the US. So 21 trillion of negative net worth divided by 141 million taxpayers is 152 grand, and that went up by 8 grand year over year. That means that if we wanted to erase this 21 trillion and get our assets in balance with our liabilities, we would each have to write on average a check of 152 grand. So clearly this is not sustainable. Now, just looking at the assets, cash was 500 billion. Loans receivable, which are mostly student loans, were 1.4 trillion. Property and equipment is just the properties, offices, desks, computers, etc. of the government, and so forth. Now, this row right here is interest-bearing debt, which includes treasury notes and other interest-bearing loans, which we raise from domestic and international sources. This is what we pay interest on, and you can see that it went up $1 trillion in fiscal 18. That's because we outspent our revenues by $1 trillion, which is also the budget known as the budget deficit. We overspent by $1 trillion. I'll show you that in a minute. In any event, this is going up, and that means interest expense is going up. Now, that's pretty much the balance sheet. So the highlight is 4 trillion in assets, 25 trillion in liabilities, a negative net worth of $21 trillion, or 152 grand per average taxpayer. Now, let's jump to the income statement. So in the overall, our revenue for fiscal 18 was $3.3 trillion. And our expenses were 4.5 trillion, meaning we lost 1.1 trillion. We lost the same amount in the prior year. Now, that is in a time where there's 3 to 4% unemployment. The country could be balancing its budget. Wouldn't be easy, but it could be. And in order to get that to zero or break even, either revenue has to go up, so we'd have to increase revenue, or we have to cut expenses. And I'm going to get into a little bit about how hard that might be. But let's look at revenues for now. What I want to point out is that, first of all, this is fiscal 18, fiscal 17. This is the difference, the change between the two. This is the percent of the change. So $105 billion additional income, individual income tax, was a 4% increase year over year. Corporate income taxes, which is this row, went down 30%. That makes sense because of the Tax Act, which lowered corporate taxes, and it lowered them by 30% year over year. And then this is other revenue. Now, this over here is the percent of the total revenues that each of these rows represents. So in this case, individual income tax here was 83% of total revenue. So you can see that individuals are paying most of the tax, corporations paying way less, And the change year over year is interesting. So individual taxes went from 80 to 83% of total revenue, and corporate taxes went down from 9% of total revenue to 6% of total revenue. Again, that makes sense based on the Tax Act that passed a couple of years ago. Now, if we go to expenses, I stratified these from high to low for this fiscal year. So the biggest expense is Health and Human Services. It includes Medicare and Medicaid. And Social Security is the next one. These two are considered entitlement programs, programs largely into which citizens paid into the Medicare and Social Security fund, and therefore these are obligatory and not easily cut. And these are both rising, as you can see here, they're rising every year as the population ages. Looking just at this Health and Human Services, it went up 56 billion or 5% year over year. And it represented 25% of the total spend for the government. That was up a point over 24% the year before. Social Security went up by 39 billion, and it went up 4% year over year and represents 23% of the total spend, up a point from the prior year. Defense went up 33 billion. So we spent almost 700 billion in defense, and it went up 5% year over year. It represents 15% of total government spending. Now, this is a killer here, is interest on our debt. So I just showed you in the balance sheet how debt, interest-bearing debt, went from 14.7 trillion to 15.8. It went up $1 trillion. And therefore, in a environment where interest rates are rising, if debt goes up, you have a double whammy, and that's why interest expense rose 61%, 61 billion, or 21% year over year, and it went up as a percent of total spending to 8% versus 7%. So it's taking up a bigger share of our total budget, and it's going to continue to squeeze out other spending and the ability to cut spending even if we don't start bringing down the debt. Veteran Affairs is the next largest item spend, and that went down by 133 billion, or 28%, went from 11% of the total spend to 8%. So that took a smaller role in overall spending. Energy went up by 100 billion, or 244%, and it took up a bigger part of the overall spending at 3% versus a prior year of 1%. Now, if I were to add up these 6 items, the biggest, that's $3.7 trillion of spending out of the total of 4.5. So that means that if you wanted to get to break even, let's get this loss to 0. We need to recover. We need to somehow find $1.1 trillion. Well, all these little guys here, from here down, this is Treasury Department, Transportation, Homeland Security, Education Department, Labor, and all these smaller departments, which only add up to 800 billion. And even if you cut, it's not going to account for $1 trillion in money that we need to find in order to balance this budget. So that means that you either look up to the bigger dollar rows, like Medicare, Medicaid, Social Security, defense, interest, veterans, energy. None of these are easy, or you have to raise revenue. And so it's either more tax revenue, or we have to cut into Medicare, Social Security, lower defense. We could pay down our debt, and that would save this interest. And that seems like a very smart thing to do. It doesn't make sense to spend more than you take in and keep paying more interest on more debt. So let me see here. This net loss for the year, when you divide it by, so it's $1 trillion divided by 141 million taxpayers, is $8,000 on average per taxpayer. That means that annually, in addition to the taxes that we pay on our own income, if we wanted to balance this budget, we as individuals would have to write $8,000 checks on average, or corporations would have to pay more. But one way or another, we would have to pay more to get this down to zero deficit. Now, let's look at a breakdown of revenue. So here you see what I just said. Individual income tax accounts for 83% of revenue, corporate tax only 6%, and other revenue is 11%. That's the breakdown of our revenue. Now, on expenses, the breakdown is, if we look at the biggest, it's 25% of all spending is health and human services, which includes Medicare, Medicaid. It includes FDA, the CDC, the National Institute of Health, and so forth. Social Security is at 23% of total spending. Defense is 15%. Veterans Affairs is 8%. Interest is 8% of our overall spending and growing. And then all those other departments are 21%. Now, this is directly from the financial report that the U.S. government put out, and I highlighted what's important. Here you see in red, there's little doubt that current policy is not sustainable. If policy changes are not so abrupt as to hinder economic growth, then the sooner the policies are adopted to avert these trends, meaning this running a deficit and running up debt, the smaller the changes to revenue and or spending will be required to achieve sustainability over the long term. In other words, the sooner we start fixing our financial house, the less pain will be incurred later on, because if we don't, debt continues to rise, interest continues to rise, and take a bigger chunk of the overall spending. And to get that in order, which is going to happen, there will need to be higher taxes on everybody. And it could be draconian the longer that the country waits. So that's a little bit about financial statement analysis. I did a balance sheet, I did an income statement, I looked at year-over-year changes, and I looked at the percent that every row represented to the total. And that enabled us to see the trends and make sense of not just one static year, but in comparison to other years. That's how the pros do it. And I hope that this helps you analyze your financial statements better and gives you a glimpse into the financial condition of the country. Now, if you like this video, please like it and share it on this site. And remember that one tip from me, your business finance expert, could be worth millions, and that profits today become fortunes tomorrow. So don't let those profits slip through the cracks. Catch them now, fix your finances, and I'm here to help you. Have a good day. Thanks.